Hi everyone, this is Vignesh from Investing Gurukul. Today we are going to talk about a basic concept, which is what is a stock. A lot of people keep asking me; they do not know the basics, so it is difficult to follow some of the videos as they are advanced for them. So we'll talk about a very basic thing: what is a stock? What are shares? How are they issued? So let's get into the details. So now let's look at what a stock is all about. So let's say a couple of people start running a business. So let's look at two people, two persons A and B. They start a company. They invest 50,000 rupees each. So together they invest a capital of 1 lakh rupees and they start running a business. The business is doing well, and over a period of 1 year, they are able to generate a sale of 3 lakhs. So they invested 1 lakh, they have a revenue of 3 lakhs. Whatever sales they generated as revenue, and after all the expenses, they make a profit of 30,000 rupees every year. So basically 3 lakhs sales and 30,000 rupees profit, which is like 10% of their sales, their final net profit, which is coming to them. Now, here is what they have done. They have spent a lot of time in understanding their business and growing their business. So they've been able to grow to 3 lakh sales in 1 year. So they want to increase it further. So they want to expand their business now by 5 times. Instead of 3 lakhs sales, they are looking for 15 lakh sales. So what do you have to do? So initially they invested 1 lakh. They need another 5 lakhs to increase sales to 15 lakhs because they need to invest more capital into the business. So they do not have 5 lakhs in hand. They do not have enough cash. Now, there are two options available for them. So, the first option is debt. They can go and apply for a loan somewhere and get it. It could be banks, it could be NBFCs, it could be private firms. The second option is equity. So, equity means providing ownership of your company to someone who is investing capital in your company. So, this is the difference. So, debt does not dilute your ownership. 100% ownership will be with you, but you can raise the money and you have to pay that money back along with a certain interest. The second option is equity, which dilutes your ownership. So someone can take some portion of equity in your company, they can take a stake and they can become part owners of the company. So you don't have to pay back the loan, you don't have to pay any interest amount. So these are the two options that are available for businessmen. So why companies go for debt and equity? So investors now they have spoken to a lot of investors to raise money, and there are a couple of investors who are interested in investing in them. So they totally invested 5 lakh rupees in total. Now when they invest, right, they need to look at an exit. They need a price point at which they have to sell. So your company is valued at a certain price point. So whatever, even if you have a bicycle, even if you have a car, if you want to sell it, there is a value attached to it. Similarly, for every business, based on their sales, based on their profit, based on their employees, based on the brand value that they possess, they come over have a valuation at which a company can get sold in the future. So now when the investors invest, they invested at a specific valuation of 50 lakhs. So basically they have invested 5 lakhs. For simplicity's sake, we do not consider pre-money, post-money, etc. So they have a 10% stake in this company for 5 lakhs. The company is now valued at 50 lakhs. If the company is getting sold today, it will be sold at 50 lakhs and the investor will get 5 lakhs in advance. So now, over the next 2 years, the company does really well. Both the founders do a lot of hard work and they grow the company from 1 lakh sales to 5 lakh sales in just 2 years of time. So your valuation goes up. So this is again for simplicity's sake from 50 lakhs, from 1 lakh to 5 lakhs, so 50 lakhs to 2.5 crores. So this is a bare minimum valuation. If the numbers are good, if the profit numbers are better, if they have a far better brand, if they have strong moats and competitive advantage, this valuation can even go up further. So if they sell the company today, it can be sold at least 2.5 crores. So the Investor who invested 5 lakhs at 50 lakh valuation, his investment is now worth 25 lakhs. So 10% of 2.5 crore is 25 lakhs. So you can make money by investing in stocks and shares. So this is the basic concept of a stock. So basically, when a company is listed, right? So this is an example of a company. A company had a revenue of 2,500 crore in 2020. Now it has come to around 5,000 crore. Look at its net profit. It has grown from 188 crore in 2020 to 250 crore, which is like more than 50%. So let's look at a real example. So let me show you a real example of this. So we'll take VGuard as an example. So let's look at the numbers of VGuard. So in 2013, VGuard had a revenue of 1,350 crores, 1,500, 1,700, 2,000. Now let's look at its number. It is close to last 12 months, it has a revenue of close to 5,000 crores. So from 1,300, it has gone up by 3 times, 4 times, or 300% growth. So now let's look at its share price from 2013. So in 2013, it was valued at around 35 rupees. Now look at its price. It went up till 470 or 524. Now it is trading at around 355 rupees. So you would have invested at 35 rupees. The revenue was at 1,300. Now the revenue is at 5,000 rupees. Obviously, the profits have also gone up from 63 crore to 261 crore. So basically, what's happening here is your revenue is growing, your profit is growing, all the numbers are looking good. So your share price will also grow. So if you have ownership of these shares, if you had purchased this company in 2013 at 30 to 35 rupees, now it would be worth 10 times. So the revenue grew by 300%, whereas the share price grew by 1,000%. So that is how it works. So So if you hold shares in a company that is doing really well, your stock valuation will go up. So this is what it is. So when it comes to stock, what is a stock? It is an option to have ownership in a business. You own a part of the business. It provides rights over the earnings and assets of a company. So there are different types of investors. People like us are retail investors, and then we have high net worth individuals who have several crores of net worth. They are considered HNIs, and then we have institutional investors who are very big investors who have professional network, and they are institutions who pull money from people and then invest in companies. So and then we have private equity firms. They invest in late stage start companies and startups. They acquire them and then they run it on their own. So these are the different types of investors who are available. The last one is mutual fund. The mutual funds pool money from multiple people and they invest it directly in shares. We'll see about mutual funds in detail in another video. So this sums up today's video. So if you like this video, please hit the like button. Please subscribe and share it with others. In another video, we'll talk about one more basic topic. So if you have any questions, if you want a specific topic or stock to be covered, please post it in the comment section. Happy investing, happy weekend.